Every investor, no matter how experienced, runs into the same tough question. What do you do when the market isn't just booming? What happens when it goes sideways or even worse, takes a nosedive? Today, we're going to break down a strategy that's built for exactly that kind of world. Let's dive into the Altiva Hybrid Long Short Fund.
I think we all know this feeling, right? Markets just don't travel in a straight line. They can soar, sure, but they can also tank. And honestly, sometimes the most frustrating thing is when they just go nowhere. That's the core puzzle every single one of us has to solve.
So that's the million-dollar question, isn't it? How on earth do you build a portfolio that can deliver consistent returns without all the crazy ups and downs, no matter which way the market winds are blowing? Well, let's explore how one fund is trying to do exactly that. And the answer, or at least one really interesting answer, lies in what's called a hybrid approach. It's a strategy that's designed from the ground up to adapt to most market conditions. So what is this thing? Well, at its heart, the Altiva Hybrid Long Short Fund is a carefully constructed mix. It blends together equities, fixed income, and derivatives. You see, the goal here isn't just about chasing the absolute highest highs. It's about trying to achieve much more consistent, smoother returns over time. The way it's structured is pretty cool, actually. It's really trying to give you the best of both worlds. On one hand, you get the tax efficiency and the strict rules you'd see in a regular mutual fund. But on the other hand, you get the flexible, sophisticated strategies that are usually found in an alternative investment fund. And it's this unique hybrid structure that really sets it apart. Okay, so that's the what, but how does it all actually work? Let's get into the nitty-gritty, the long and the short of it. The engine that powers this entire fund is the hybrid long-short strategy. Now, it might sound complicated, but the core idea is actually pretty straightforward. It's about doing two things at once. You're taking long positions, which just means buying things you think will go up, and at the same time, you're taking short positions to act as a hedge or protection against things you think might fall. A fantastic way to think about this is like you're managing a sports team. The long positions, that's your offense. They're out there trying to score points to get to that capital growth when the market is doing well. And the short positions, which use derivatives, well, that's your defense. They're designed to protect your portfolio, to guard your capital when the market takes a hit. So if we peek under the hood, what does this team's lineup actually look like? Well, the foundation, the real core of the portfolio, is built on fixed income, a really solid chunk, around 40 to 60%. Then you add in arbitrage strategies at 20 to 40%. These are your stable, reliable players. And then you have the more tactical parts, the derivative strategies, and a smaller opportunistic slice for what's called special situations. This whole thing really rests on four distinct pillars. Pillar number one, fixed income. That's for stable, predictable income. Pillar two, arbitrage. This is all about capturing small, low-risk profits from tiny price differences in the market. Third, you've got special situations, which means taking advantage of unique corporate events like IPOs or mergers. And finally, pillar four, those derivatives we talked about, which are used for both hedging your bets and trying to generate some extra returns. So with these four pillars all working together, we have a really clear structure. But what does that actually mean for you as an investor? What kind of performance can you expect? That brings us to the most crucial part of any investment, balancing risk and reward. Okay, now this is probably the most important slide we're going to look at because it's all about setting realistic expectations. This strategy is specifically designed to outperform when markets are flat or even in a sharp downturn. That's where it's built to shine. But, and this is key, there's a trade-off. It's generally expected to underperform in a roaring bull market or when things get super, super volatile. So the takeaway here is that it's not about winning every single sprint. It's about having the stamina to run the entire marathon. And this whole philosophy is really summed up perfectly by the funds managers themselves. They say active management and strict strategy-level risk controls help reduce portfolio volatility, provide downside protection, and deliver more stable outcomes. You see, risk management isn't just some feature they bolted on at the end, it's baked right into the DNA of this strategy. All right, let's switch gears for a second to something that often gets overlooked but can make a huge difference to your final returns. I'm talking about tax efficiency. Take a look at this number. 12.5%. So, what's so special about that? Well, that right there is the long-term capital gains tax rate that applies if you hold your investment for more than a year. And when you stack that up against some other options out there, it can make the post-tax returns, the money you actually get to keep, look really, really competitive. It's a pretty significant structural benefit. Okay, so we've covered how it works, what to expect, and the tax benefits. All of that brings us to the final and maybe most important question.
who is this fund actually for? How do you know if it's the right fit for your portfolio? Let's make this personal for a second. Thinking about your own financial goals, your own tolerance for risk, could a strategy like this actually make sense for you? Well, here's a quick checklist. This fund might be a really good fit for you if you're investing for the medium to long term, if you want a mix of both capital growth and some income. It's a great fit if you're looking for more of an all-weather strategy that has lower volatility, or if you really want that downside protection in choppy, uncertain markets. And, of course, you have to be able to meet the minimum investment requirement, which is 10 lakh Indian rupees. At the end of the day, it really all comes back to this one clear objective: to generate consistent, low volatility returns by bringing together a combination of different strategies, all under one roof. So I'll leave you with this one last question to think about. When you look at the markets today and you look at your own investments, is your portfolio truly prepared to play both offense and defense?